Remember at the start of this module when we looked at cash and derivative instruments?
Yes, I remember. When a flower seller sells to a customer at his stall, that's a cash instrument. And if we were to bet on the price of the flowers, that would be a derivative instrument.
Good. When you enter a CFD trade, you are agreeing with the other party, normally your broker, to exchange the difference in price of an underlying asset. It's a classic derivative instrument. Typically, they are not traded via a central exchange, and also they're known as being traded in an over-the-counter market. We'll cover OTC markets in the next module.
What do you mean, difference in price?
Well, this is the difference between the entry point of the CFD and the exit point. If we think back to our first BP share example, a CFD would be a contract for the difference between the £5 entry price and the £5.50 exit price. You and the other party are only agreeing to exchange the 50 pence difference.
Ah, okay, I understand. So it does what it says on the tin. It's a contract for the difference.
Exactly. An important point to note here. As a trader, you don't own the underlying asset. You are only interested in the change of its price. It's a bit like our flower trader example. We don't own the flowers. We are only interested in the price at which others are buying and selling them.
Got it. But how do we know what the underlying asset is that we're trading?
Well, that's defined beforehand. For private traders, CFDs are standardized and the name on the contract will be clearly labeled. For example, BP CFD or UK 100 CFD.
Good. Just checking.
A few decades ago, CFDs started being used by asset managers in the city to hedge shares. To begin with, the managers just hedged individual shares, but this evolved into them using different underlying assets such as indices and forex.
What does hedged mean, Philip?
A hedge is when someone performs a transaction to offset an existing investment or risk. A hedge might happen if it's difficult or expensive to sell the initial investment.
I'm still not clear on this one. Can you give an example?
Sure. Let's show this on a chart to make things easier. So, if you use our BP example again, let's say a UK-based investor owns 100 BP shares, and let's use the actual price in the chart, £4.80. They are nervous about a short-term event that they think might impact the share price. They still want to own the shares in the long run, but they want to protect themselves against the potential short-term move. This happens a lot in investing, where events like a change of government, CEO leaving, oil price volatility, and so can bring short-term concerns to investors. The first option our investor has is to sell the shares and repurchase them when the risk has been averted. But this involves significant transaction costs and a 0.5% UK stamp duty charge when the shares are repurchased.
So it's expensive to sell and repurchase shares?
Relatively so, yes. Instead, they can sell 100 CFDs to cover the value of the shares. That means if the price falls below £4.80, they make the difference multiplied by the 100 contracts. They can buy the CFDs back when they are confident that the short-term risk has passed. Because they aren't trading the actual shares, they don't incur the stamp duty charge, only a relatively small commission and funding charge from the broker. This way, they can keep on owning the shares and protect against the short-term risk while the CFD is open. Let's fast forward our chart to see what happens to the price and both positions. If the price falls, the profit on the CFDs offsets the losses on the underlying shares.
I see. So it's a way of protecting against falling prices?
Not necessarily. If we fast forward again, while still holding the CFD hedge, we see that if the share price go up above the entry price of £4.80, the CFD starts incurring a loss because the difference in price is no longer in the investor's favor. This loss is offset by the profit on the shares.
So it's used to get you out of the market without actually selling your shares?
Yes, but only if you fully hedge. In this example, selling the 100 CFDs hedges the 100 shares exactly. What the first users of CFDs realized pretty quickly is that you can use them not only for hedging, but for speculation as well. If you think the price will rise, you buy a CFD. If you think the price will fall, you sell it. We'll be looking at buying and selling in the next module, so we won't go into too much detail here. If traders are only interested in price differences, why bother owning the underlying shares at all? Why not just buy or sell a contract for the difference?
Ah, I see. So instead of us having 100 BP shares, we have 100 BP CFDs.
Exactly. Traders do this a lot. The next big advance came when the internet was introduced to the masses at the end of the 90s. Before then, CFDs were only really used between banks, hedge funds, and institutions. Large private investors got access via specialist brokers, but CFDs were certainly not a mass market product.
Before my time, Philip. I was still at prep school then.
The internet has really helped distribute CFDs inexpensively to private investors and traders. With this growth and a good degree of competition, we've seen a lot of innovation surrounding the product. It became quick and easy to trade. The cost of trading has plummeted and the range of markets offered has widened. As well as individual equity CFDs, you can now trade index, forex, commodity, and bond CFDs. You can even trade cryptocurrency and property CFDs. The choice is impressive.
So have I got this right? CFDs are still used by big financial institutions, but now lots of private traders like me are also using them.
Yes, correct. CFDs are also used by non-financial companies to manage risk, like food manufacturers, farmers, and miners. And they're still used by long-term investors for hedging their portfolios. In addition to the reasons we just looked at, these types of users like CFDs because normally you can offset any losses that come from trading against corporation or capital gains tax. This is a bit technical, but basically it means that the taxman is happy for you to offset the side of the transaction that makes the profit with the side that makes the loss.
I can see why that is useful.
Good. Now, that just about covers the main points on CFD. Next up, we are going to introduce a close relation to the CFDs, the financial spread bet.